TGIF Warriors. Hiya, Paul. Richard Wares. Oh, you're very welcome. Glad to add value. The whole team. So, team.
Hey, good morning, Dale. It looks as if there's not a lot of people around here.
Well, the important ones are here. In fact, you know, to be there for the good times, you have to be there all the time.
That's exactly it.
Okay,
Well
so,
said.
Yeah,
Well
okay.
said.
Thank you, buddy. So, Euro, I think we have an important top. I was short cable coming into the BOE. I'm still short. I took partials, but, you know, Aussie was given all kinds of tells that it didn't have it. But I think that this could end up being a pretty important low for the dollar. And, you know, my narrative is that those are the lows. I don't know if we had a reversal week. It's Friday. Let's check it out. Not quite, you know, but a higher low. I think you could be long the dollar against the low. Bought dollars yesterday, and I'm thinking we got something like this from here. Take it up to, you know, 106.50 if there's a quality 670. I guess we could blame it on, or the reason, risk off. The S&Ps, I was very almost like shocked by the strength early on yesterday when we got all the way up here. But, you know, it just keeps giving it up. You know, if you want it to be real simple, a simpleton technician, you know, you just, is it holding the uptrend? It's breaking the
break below right now.
Yeah, it's breaking the uptrend. So that's a pretty basic line. Ugly.
Yeah, there's a lot of panic in the market all of a sudden since yesterday. This morning it was the excuse was to sell off Deutsche Bank.
Yeah, I see it down 10%.
Yeah, I mean something again for the bonds and redemptions and a bit too many officials coming out saying that there's no problem and then scrambling back like Yellen did yesterday as well. So it's a lot of that big wave of risk off this morning in Europe again. And yeah, I mean, as you say, the dollar is the mechanical beneficiary of it, right?
Yeah.
If bonds go up, if stocks go down, if the shit hits the fan everywhere, people go back into the refuge and dollar and metals.
Yeah, I'm really I was surprised to see silver up today.
Yeah.
With a strong dollar and weakness, it's really showing relative strength. And I'm still short, but it keeps grinding me. You know, last night it was down a dime, but yeah, gold and silver, and to also, what's the other safe haven that people are looking at least Bitcoin's given it up, right? It didn't make a new high.
Yeah.
And Ethereum had a classic stop hunt. I think the cryptos look negative. Okay, so you know, I'm thinking strong dollar, weak crypto, and a correction in metals eventually. So, because I think there's a possibility that in like Euro, that this is a failing rally, that we're headed back under 104, and we might try and test some of these fibs. I know Blake's you know, narrative was to be able to buy Euro under par or at par, and I think he'll be able to do that. And cable, you know, 61.8 back, 111.5. So we break this down, it measures 113. Okay, so anyway,
I think for that to happen, there must be a lot of bad news coming out of Europe
out
right
of
now.
everywhere.
But I mean, that big blue line there that you have is exactly my major level, 117, mid 117s. is my big
Yeah.
parameter for strength or weakness in the cable.
Okay, and that's a 700 pip formation from the 24.5 high, right? So
Yeah.
if we break down, simple arithmetic is subtract 700 from it, and
Mhm.
what do you get?
I know, but you have to break down first, right?
Yeah. Well, did I ever teach you the cursor method?
No.
Okay, this is what you do. You take your mouse and you put it on the candle, and then you go 1, 2, 3, and drag it in the direction that you want the market to go.
Okay,
You put a magnet on your
sure.
screen, and
Under
you
your
just go,
screen. Under your screen,
go
yeah.
down,
I
go
know.
down. What?
And if it goes the other way, you just turn around your screen and you will still
It-
be looking at something.
yeah, you turn your screen. A friend of mine used to say when I was learning and losing, Dale, why don't you just turn your charts upside down? And,
Exactly.
and that's when it was in a book. You carried it with you. It was on paper, it wasn't on your screen.
Exactly.
Anyway, yeah, uh, I don't know. We're having a financial crisis.
Yeah,
At
well,
least the
the market
market
trades it
thinks we
that way.
are.
The
Huh?
market the market trades it that way, and we have to notice that and this whole thing actually got accelerated from when the pandemic started. We have been in 2 3 years now of really accelerating every move that you can imagine, and we know that historically we have seen huge bond moves and huge equity moves and everything, but it's not really the direction that things take. It's the volatility of everything has really been accelerated. And
Velocity.
yeah, we're having another example of it right now. One day everything is pretty much okay, and the next day, I mean, Earth will stop turning. So yeah,
Yeah.
and we're not out of it. I think it will continue for a while unless the global economic data hold up very well and the bank situation quiets down. Then you will see this market go completely the other way around again.
Yeah,
It,
because if it was about interest rate differentials, and I guess if the S&Ps weren't under pressure, uh, how much did BOE raise again, Ryan?
25.
25.
Hmm.
Okay, and ECB 50.
Yeah, that's where I didn't follow yesterday's move, and I understand all the risk off and everything, but I didn't understand yesterday's move in European yields, in sterling yields that collapsed as much, even not more than the dollar yields. So there's still one big trade, but I didn't really understand why yesterday the European yields were sold so much.
Here's $1 million question. Where's the bottom?
Give me $1 million and I'll try to tell you. Some people argue we're going back to 110.
That's like that joke of the stock. I make all my clients millionaires. They started with 10, but I make them millionaires. Anyway, yeah, platinum is not confirming the move in metals either, and that's what a lot of metalheads look at. But this is pretty amazing how it's levitating here. We're still diverging. I'm going to hold it and try it one more time a little higher, maybe 23.50 next week if it gets there. Gold probably has to take care of unfinished business and
That's
take out this high, right?
mhm, mhm. Yeah, and we've got a bit of extension here as well, right above 2000. We've got that high
2020.
from when was
Oh,
it?
you're talking 2070. Yeah, 2070 is a double top.
Yeah,
See it?
but also we've had in April 2022, we've had already the last try here around 2000. I think it's going to just depend. Well, I think it's going to depend on whether how much more pain this market has to take. The more pain, the higher this one can go, right? Because
Yeah.
everybody's
Well,
uh,
here's the double top you're talking about right here. That's a
No, 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 not the
2070.
double top, the prior top. I say just
Oh,
in
in 2011.
20, no, 2020, April 22 was just below 2000, and we are turning around the level, right? So, yeah, oh yeah,
Oh, you mean 1960, the prior high before we pulled back to
it's on the
1800.
shorter term, but don't worry. Yeah,
All
yeah, yeah.
right. Anyway. Okay. All right. So, really, what are your thoughts in what we have going on here in U.S. dollar yen? Pretty
Being
ugly month.
being Friday, I don't want to counter trade it.
Yeah.
But it all depends how the Americas will look towards risk and bonds this afternoon, this morning for you.
Well, the yields are pressing new lows with the yen.
Yeah, absolutely. Yen is back to well, it's still on the yields train, but also back into the risk fold, which we lost for a few months.
Yeah.
Now
Risk
we're
off.
just
Yeah, for a long time. Yeah.
yeah, we gave it up like April or so last year for
Yeah.
at least 8 or 9 months, and then now it's back though. I really I don't want to make any bets on where the yen is gonna go right here and now. It's very volatile. I'm pleased to think still my overall view is that Ueda is not going to be the big reformer, but that maybe just it's far too early to say so. We'll have to wait and see.
Okay. Um, Someone brought up the VIX. So I'm a glutton for punishment, and I bought more VIX calls after I gave that big rant about how they didn't pay me when it was intrinsic. I had, intrinsic value, but I did it again. I went further out to July, but here at 20. And look at where we're at in a matter of a few days, back at 24. So a higher low in VIX, I think it's going to break out this time. Maybe we're just going to get it over. Everyone's embraced,
Hey
you
Dale.
know, the range thing, and maybe we're going to take out the range.
Hey
Good
Dale.
morning, Steve.
Good morning. Okay, I just hung up the phone with a very close person to me that is a high ranking person in Deutsche. I asked him, if he thinks he would be very honest with me that they have an issue. He says that they have no issue whatsoever. Just letting you know.
Oh,
He
okay.
says that they're super overcapitalized. They have 250 billion in liquid assets,
Yeah.
a lot of deposits, and he thinks this is a witch hunt. Just transferring the message.
Oh, a witch hunt by what? By traders?
By the markets,
Okay.
Steve,
And
is
they've
this the
been
gentleman that is
It's
this the
always the
gentleman that I
market's
met
fault.
about 7 or 8 years ago?
no.
Oh,
That's a
okay.
different gentleman with the same name.
Got it. All right, got it.
Steve's wired into, throughout Europe. In fact, these guys call Steve for his opinion. Right, buddy?
Oh, having to do with markets? Yeah, on
Yeah,
occasion, yeah.
yeah,
Of course, we do exchange
yeah,
opinions.
yeah. No, and how to run their bank and
No,
how the central bank should be run. They don't ask about that?
no, I don't have a direct line to the CEO or the
Lagarde? You haven't talked to
yeah,
Lagarde in a while. All right.
yeah,
So
and
what do you think? How do you encapsulize this week, Steve? The most important thing that happened that here we are Friday.
listen, it's more than obvious that, in my opinion, what is supporting the dollar at the moment is risk off, right?
Okay.
And that's what we were saying yesterday again, that the dollar is probably about to go.
Yeah.
Unless, of course, we get risk off, and we know that under risk off, right, treasuries are a very appealing destination, and hence flows to the dollar are, inevitable, right?
Yeah.
Now the question is, and this is a multi-factor issue. The question is, if we get over the whole things are not going well with the banks, things are about to break, etc., or not.
Yeah.
And I don't think it's very easy to make that call at the moment, right? The markets are obviously focusing there. From the other hand, central banks and regulators are, pulling everything they can out of the hat to make this go away.
See, let me ask you this. Even if we get these things all solved and no banks, no other banks fail, and you could give central banks whatever they did, the liquidity crisis at the banks is stabilized, and we don't hear about it. There are ramifications, even though they save these institutions, like less credit. They're regional banks that support businesses in there. That's who they go to. Local businesses go to banks like that, and they're not going to have credit. So the next stage is what? Is it a credit crunch?
I don't think they're going to let that happen, right? One way or another. Now, having to do with what you said, that is a big issue. Meaning, by doing what they did, and we said that from the very first moment, and that is not something we said alone because it's a very obvious thing to notice.
No, we're the only ones that said
it. They create a lot of moral hazard, and they create a two-tier banking system. So now we're either going to see a lot of those regional banks become completely obsolete because people won't want to be there, or we're going to see, which is a very probable alternative, what usually governments do. And as I've said before, I consider central banks, unfortunately, an extension of governments. They're going to try to fix one mistake by making another mistake. Now, I don't know what kind of other mistake they might do to not, in essence, get all the regional banks extinct, right? Because they obviously don't want to fix the first mistake, which is going against capitalism and, in essence, initially claiming that there is a specific insurance guarantee and then extending that to an indefinite amount if you happen to be in a bank that is considered systemically important or big enough to cause an issue if it fails, so on and so forth. But generally, this is a chain of events we've been seeing unfold during the past 15 years. That they're trying to micromanage markets and market events. And for every time they intervene, there are more reasons to intervene in the future.
Okay. So you got the break. You said you were upset that, how well the S&P's held up during the initial stages.
Yeah, we got rejected the day before yesterday in an attempt to break out higher, which means that
Fed Day.
we had that initial reaction higher. It was looking like the S&P wants to break to the upside, but by the end of the day, we had this big reversal. Yesterday we had a very volatile session as well. Today we seem to be outright moving to the downside.
I was surprised after this candle that we got all the way up here. And I thought, they fixed it again. And then later on, boom.
One thing is for sure, the markets are not boring these days.
They're not trading well either.
Yeah, I agree. Hold. This is unfortunately the type of volatility that is not necessarily very pleasant to have because there's a lot of whipsaw moves happening. So people need to be very careful.
Yeah.
People need to be very careful with leverage they use. They necessarily have to use less leverage, as you like to say, not only because the markets are volatile, but also because they will be forced to use wider stops in order not to get whipsawed from these markets, right?
Yeah, that's in the song too. Use wider stops so you don't get picked off. Yeah. Look at Russell. This is the U.S. and also a lot of banks in this. We're like, a couple days away from taking out the October low.
Yep.
The Russell.
Yeah, I know.
There's your weak sister. And then, so you look at that chart and then you look at NASDAQ and they look like two different markets.
Yes, but I don't think the Nasdaq will be able to. I mean, there was a lot of money piling in at the beginning of the year back in the Nasdaq, with a strong belief that the move that started and mostly focused on all the overhyped stocks was overdone, and 2023 would be the year that all those stocks would, in essence, come back with a vengeance, right?
Yeah.
And the market still hasn't lost faith in that. Needless to say, this is a very, very dangerous proposition, because if the markets, I mean, I've been saying so many times that the markets are doing really well and much better than expected. But if, the beginning of some kind of a reversal again is whatever, in this case, likely risk off with fears about the financial system and the banks, etc. If this thing escalates, there is no way that these stocks are going to do well. I think they're going to do worse than anything else once again, because they are the riskier assets among equities, right? I mean, what are you going to be owning? Are you going to be owning Tesla if things go bad? Or are you going to be owning a food
Northrop
company or a tobacco company, or you know what I mean?
Military industrial complex.
Yes,
They're making money.
telecoms company or any of the defensive companies, right? There's
Yeah.
going to be again a rotation towards the more defensive names out of the highly speculative names.
Okay. We'll see if bonds could break out this ascending triangle right in the middle. So, what do you think yields here, Steve? We going to 3%?
Well, the problem with yields is that at the moment they have nothing going for them, right?
Yeah.
Meaning risk off is flight to safety. Flight to safety is buying treasuries. Treasuries being bid means yields go down, right? So that's one. Even if this situation is somewhat resolved, the market is now rather convinced that even if the situation gets resolved, the Fed and other central banks have already got the message that, listen, guys, you probably already flirted with the breaking point. So there's one way from here, and that way is down, having to do with rates.
Look at Deere rolling over. So here's like a international company, and the real economy, Deere, and this is a weekly 3 drive on the verge of breaking down, and
although this is a chart that still looks long term good, right? I mean, for the time being,
300.
Yeah. For the time
Hello,
being.
everybody. Sorry, I'm late.
Hey, Stel.
Hey.
And we were wondering,
here's your
why is
favorite
she late?
subject.
Bitcoin.
Yeah. It's unchanged on the week.
Yeah, Bitcoin is surprisingly holding up well at the moment.
Yeah.
And the rest of the cryptocurrency, the bigger cryptocurrencies.
Ethereum's weaker. It had a stop hunt yesterday.
Yeah.
Weaker. Anyway, it's hard to find things you want to be long right now, isn't it? Except for gold and silver. Huh?
Having to do with equities and risk assets, you mean?
Well, FX, oil, across the board. Beans.
Yeah, crude oil rolled over again. We were saying yesterday on the morning edge that crude oil looks very appealing at the levels it was backtesting to be short again if it wants to roll over, and indeed it has done so, right? So definitely crude remains in the defensive, and in my opinion, I've said it before, 60 to 80 is the next downside target for oil. So we might see in this move lower that level being tagged, I think.
Okay. And Steve, your upside target in VIX?
I think VIX, if really things escalate here, VIX has a lot of upside potential. A lot of upside potential from
Give
here.
me a number.
100.
To begin, yeah, to begin with, there is a long-term. We have created some kind of a ceiling for the past 2 years that's
Like
roughly at
38?
35. Yeah,
yeah.
35 to 38. So I think we can at least get there.
Right. And if we break out, you're talking
Then
what? 50?
we're going to be looking for much higher levels, 45 to 50. Yeah.
Okay. All right. 5 minutes. Let me see if my guest is here. Our guest.
What are we looking for?
Sign.
Have a look.
I got a few things to say today.
Oh yeah, I didn't know. I was
Oh,
waiting.
yeah.
I was
What's
waiting.
that?
You
No,
didn't
I was
ask
just
him.
waiting for Steve. He's got his thing he's wanting
Grab
to
the
do.
charts,
So,
bro. I thought maybe you were busy
okay.
doing something.
Yeah, I guess I'll quickly cover a few things here. Happy Friday, everybody. So I think the first thing we need to look at are yields. I know Steve was just mentioning them, but you know, we're at a lot of like just support in yields. Bonds are rallying towards like some pretty key resistance, right? You know, the big moves have been in yen overnight, but I tweeted out a little while ago, I am done with the yen, and I'm done with the yen just because of where we're at, but I think the yen's got a lot further to go. Personally, you know, I think that the risk is manageable. And the one thing I did want to say about the yen and all of them is when you have every cross moving in one direction in the FX market, it's really hard to try to stand in the way. It's kind of like it's like a train. You know, you either get on the train or you get the hell out of the way. That's the way I have always looked at it when you have every cross moving in one direction. So, you know, you have the dollar yen that's obviously, you know, testing the waters around 130, which is really, really critical, right? That we have completed the flag pennant pattern. RSI is divergent. We're at the 78% retracement. Personally, I think we're going a lot lower because, you know, technically this long-term flag pattern points a lot lower. I just don't know if we're going to break down, you know, here like right now in the near future. But the problem that, you know, all these yen pairs have is you got the euro yen, which is attacking major triangle support. Now this is a daily, oh, no, I'm sorry. This is not a daily chart. This is a daily chart. So you can see it here. You can see that, you know, we've had months of a consolidation, or basically a year of a consolidation. And if we break, we're going to break hard, and we're testing the waters right there. Pound yen, same thing, big triangle pattern. You can see here. I've gotten some, you know, lines drawn here. Don't look at those too much. Aussie yen breaking down major support, right? Kiwi yen, same thing. Canadian yen, same thing. So when you have the whole complex moving down, it's really, really hard for me to sit here and go, well, it's, you know, I need to take the other side of that trade. I booked profits because I was already well positioned for this, but you know, to try to just because, you know, and I always get this question. I know you guys do too. When I get out of a trade, people ask me, well, if you don't want to be short anymore, why don't you just buy it? And it's like, that doesn't make any sense to me. You know, there's a time and place to book profits. There's a time and place to reestablish trades. There's a time and place to actually stand aside. When there is a lot of risk right now globally about banks, Steve just said his buddy at Deutsche Bank said, you know, hey, they're fine. This is a witch hunt. Nothing's going to happen.
Sounds like Trump.
Well, I mean, yeah, that's great, but he also isn't the CEO, and, you know,
yeah.
and so we don't really know, but it's a good insight that probably is realistic. But how about if he's wrong? You know, then there's just a lot of risk. Obviously, DB's in the spotlight right now, and the fact of the matter is the stresses that we're seeing from, you know, from interest rate hikes globally, especially in the Eurozone, could weigh on, banks. It obviously is doing the same thing in the US. So there are a lot of risks out there, and I think we just have to be cognizant of them, and we have to be very nimble right now. So when you get yourself in a profitable position, it's always good to book profits, at least a portion of them. Move stops, manage your risk. Don't carry heavy positions over the weekend, which, by the way, today is Friday. Anything can happen, and we could gap wildly in one direction or the other. And there's nothing you can do about it. You're just going to get up on Sunday night or Sunday afternoon, depending on where you're at, Monday morning, and you're going to look at the markets and go, shoot, I'm either dealing with this like nasty loss, or, you're booking some profits and walking away, and it's a big crapshoot. So be really careful. That's why on days like today, it's Friday ahead of a weekend where anything can happen. I'm happy to book some profits. Anyway, I'm going to leave it at that. There's so much more to cover, but don't worry. We'll be covering a lot on the morning edge in 45 minutes. If you're in the ForexAnalytix community, we'll see you there. If you guys haven't checked out the trader funding program, make sure you do that, because if you want to be inside of our community and you also want to trade our money, take an assessment. That's the benefit of going with the trader funding program, is you're in probably the most active, robust trading community. And you can see what I'm trading, what Ryan's trading. You can see what Kman, Stelios, Steve, we all, Steve hasn't really put much in here in the trades, but you can see trades that I've been doing, and everybody else as well, and all these other chat rooms that are also busy. Anyway, Dale, I know your person's here. You guys have a great Friday. TGIF.
Thanks, Blake. Thanks for another great week, team. Appreciate all your efforts to edify the community, give them ideas, teach at the same time so they understand the hows and the whys. That's the important part. Ronald said there's a prophecy on a European bank failure. Okay, well, David, it's really nice to meet you. Welcome to F.A.C.E.
Hey, Dale, good morning. How are you?
I'm good. You were recommended. So, I went with the recommendation, and, always willing to learn from everybody. So,
all right. Well, I hope I don't disappoint.
Okay. Well, I'd like to start off with maybe get in a time machine, and let's go back to right before you started your career in this business. What were you doing? And tell us a little bit about your journey from point A to point B. The highlights and the lowlights and the lowlights.
If you want to go really, really far back in time, I'm a dinosaur. So, my first job out of college.
Welcome to the tar pit, my friend.
First job out of college was with Wells Fargo. I went through their credit training program. It was 2 years of just, looking at balance sheets, looking at cash flows, building income statement models, just getting down to the real basics of credit underwriting, and also looking at bank operations, how the banks fund themselves, treasury operations,
Wow.
et cetera, et cetera. So they called it, I don't know if they still call it this, it's been over 20 years, but they called it at the time Wholesale University, for understanding wholesale funding markets and how those impact credit underwriting.
Oh, wow.
So from there, I went
Great
to
background to have in this current environment.
Yeah, unfortunately, I've forgotten most of it. I've got the basics down. The big picture ideas are still there, but a lot of that real granular stuff is out in the pasture.
Okay. All right.
But from there, I went to JP Morgan, their emerging market fixed income desk, and I was a sales trader there. So I was what they call now a flow trader, and I got my feet wet in emerging markets, fixed income, and then from there I bounced around UBS, grad school, back to UBS, Morgan Stanley. A lot of work in Latin America, South America. Spent a good portion of my time down there, and so now I'm on my own.
Okay. All right. So do you trade?
I trade. I do a lot of day trading. I do a lot of asset allocation. I do some systematic trading, signal-based quantitative strategy management. So
Okay.
a lot of the stuff runs itself. My job as a strategy manager is to manage the risk, manage positions, keep the overall portfolio in line with what I believe are the appropriate risk and return guidelines.
So what is?
And then
Go ahead.
go ahead.
Oh, what is Pinebrook Capital? Is it an RIA? Is it just a title of? Do you offer research to people or guidance to people? What
So
do you
the
do at
answer is
Pinebrook?
it's a personal investment vehicle for myself and some family assets.
I got it. Okay.
So I don't manage outside money. I'm not soliciting outside money.
Okay.
That's a real regulatory nightmare.
Yeah.
I'm pretty active on Twitter, really as a kind of a medium or an outlet to just put my thoughts on paper, formalize some of my thinking, get it out there, see where I could be wrong, see where I could be right.
Okay.
But it's really a real thinking out loud type of medium for me.
Okay. I went through your stream, and to me, it seems like you have a contrarian view on housing. That people have been predicting a housing crash. I don't know. I mean, I've heard people say prices are down 20% in hot markets that were hot. You feel that that's not what's happening here, that there is no housing crash. Am I reading your stuff correctly or what?
The answer is you're not wrong, but there's a lot of nuance to it. So what is a housing crash? For a lot of people, that means sales are down, prices are down. That's not the way I view it. The way I view it from more of a fundamental macroeconomic standpoint, which is the housing, the cycle, the economic cycle is very tightly linked up to the housing market, specifically construction within housing. So the metric I like to follow is fixed residential investment. So in 7 out of 11 post-war recessions have started with the housing market. And the reason for that's simple. The housing market's highly interest rate sensitive. So what some people view as a housing crash, whether it's prices or mortgage applications or volumes, to me, that's not really what matters, because that's not real economic activity. What's real economic activity is people who are employed and money spent on materials. That's really the driver. It's not, price doesn't make it into the national economic accounts for GDP accounting. Construction does. So that's what I look at.
Okay. And there are no signs of slowdowns. I know a lot of people watch the employment level of construction workers for that type of reason, right? If they start getting laid off, there's a problem. That's not happening.
That's right. So by that definition, housing has been a net drag on GDP. I believe it was last quarter. I believe it subtracted somewhere around 1.6. Don't quote me on that, but it subtracted from GDP. So it's a problem. It's a problem for sure, but not enough to tip the economy
Not like
into a
08.
recession.
Right.
Not by a moonshot. That's a whole different paradigm, and we just won't have that again, because the regulatory framework for bank financing won't allow that to happen. Now you're not going to have speculative marginal buyers levering up on credit to buy housing. That's just not going to happen anymore.
And the banks, after the last housing crisis, they don't hold mortgages on the books. Don't they just package them and put them out into the market where they don't have the risk?
For the most part, that's right. Especially on the, if it's conforming, there's no reason why, if it's a standard conforming mortgage, there's no reason why a bank should hold it on their books, for sure.
Okay, so in this environment of a liquidity crisis happening in some banks here in the U.S. and some banks, all the killer bees are out. Deutsche Bank, it's Deutsche Bank today, it's Credit Suisse last week. How do you navigate and trade around a liquidity crisis in the global banking system?
The answer is I'm taking my cues from the bond market. So that's something I follow a lot because of its, obviously its sensitivity to the economic cycle. So, just it's a good segue into something I wanted to talk about, which is, how much things have changed and gotten repriced in the past 2 weeks since I think I just lost you, Dale.
Yeah. Are you surprised? But no, I'm still here. I'm just going to
Still,
show the bond.
Okay, got it. Okay.
You're still here.
All right, fine.
We're in smaller boxes, so I could show like TLT as a proxy for the bond market.
Sure. So prior to SIV, Silicon Valley Bank, I think there was a lot of hope for a soft landing. Equities were still, they were still down from their all-time highs, but not anything horrific. It looked kind of mundane, and the big question was inflation, and then that suddenly changed over the past 2 weeks. The Fed meeting just kind of put the icing on the cake, but the bond market started having a seismic shift starting 2 weeks ago. Just for example, on short end, the long end, 10s are down about 80 basis points. Twos are down about 120 basis points, and the 3-month bill is down about 100 points. I mean, that's just in the span of 2 weeks. That is absolutely crazy. The market was pricing in around 1 or 2 more hikes. At this point now, the market is saying the hiking cycle is over. It's been taken out to the shed, and I'm looking at the CME probability table for Fed funds hikes and Fed fund futures. And right now, as of this morning, there's a 70% chance of a cut in the May meeting. So, I mean, that just shows you how much things have changed. We've gone from the Fed is not cutting, they're still going to still hike, to now they're going to start cutting in May. That's pretty dramatic. Let me pull my window back up.
So do you are you going out and extending maturities? I look at this TLT chart, and technically it's an interesting formation. If we break out over 110, you're talking about maybe 130.
So on TLT, I typically trade the underlyings using either the direct bond or bond futures, but it really doesn't matter. I think the way I'm viewing this is what's going on now relative to history. Typically, in a Fed cutting cycle, the Fed will cut 300 350 basis points, and I think now, because the curve is so inverted, when the cuts do happen, that the 2-year will have more to fall than the 10-year, because
we're going to see yields go from inversion to beginning to steepen
in a cutting cycle. That's correct. But for now, the 2 years already come down, as I said, about 100. I'm sorry about it's already come down, about 120 basis points. I was eyeing a long in 2 years before SIV hit the tape. I never put that on. I think now, though, what's going on is a lot of that short short 2-year was a very crowded trade before Silicon Valley Bank. So there was a short covering scramble that got ignited with that. A lot of big name brand hedge funds are down significant double-digit losses this month and the quarter by extension. So I'm trying to figure out how much of that 120 basis points move on the 2-year is a fundamental economic repricing, or is it
fear?
This was a violent short cover that just took a lot of people out, and we could see yields pop up in the near term. So that's one thing I'm looking at is the flow driven short covering rally in twos.
Okay.
But big picture, the way I would play my broader thesis of a disinversion in the curve would be by going long twos, because that went up the most. So in a cutting cycle, that will likely fall the most.
Okay. Any view on the dollar? Does that go into your considerations of what you do in the markets?
The answer is no, because I'm not trading forex is the answer.
Okay. All right. And metals or energy or any other sectors, but mainly just yeah, let's face it, your background was in credit originally, and you kind of stuck to the bond side of the table most of your career, didn't you? Whether it was emerging market,
Yeah, that's right.
right?
That's because that's my area of interest, and that's kind of where I've just spent more time doing. And it allows me to covering the bond market allows me to make sense of a lot of the economic data that comes out, and also trying to put together what's going on through policymakers' heads. And it sounds a little wonky and esoteric, but if you can manage to get into the institutional thinking of the monetary authority, in this case the Fed, you have a better chance of figuring out the bond market. And if you can figure out the bond market, then you can figure out pretty much every other market, including Forex. But I take my analysis one step further from the bond market to the equity market. So
okay, let's talk
right
about
now,
equities.
yeah. So right now, well, let's get back to the economy, and then we'll get back to equities. So right now the economy, the nominal growth is still strong. There's still a lot of spending power in the economy, right? After all the stimulus went out the door, over $2 trillion of stimulus went out the door. There's still a lot of money sloshing around the system. Nominal spending is still high. It's running, nominal GDP is running around 7%. That's a little hot for the Fed. They are looking at they'd be more comfortable with a 4% nominal GDP, so 2% real, 2% inflation. So that's kind of what that's kind of their target sweet spot. So we're running at 7% nominal GDP, and inflation is still above target. There's a disconnect between what the Fed is saying they're going to do, which is keep on going with inflation and not cut, as Powell said on Wednesday, or the bond market's calling their bluff and saying no. Is saying to the Fed, no, you're out of whack here. It's just not conforming to reality. So there's a big disconnect that will have to resolve itself in one way or the other. So what is that one way or the other? Well, again, now we're transitioning to equities. So how does this resolve itself? If the 2-year, if the curve right now is saying, okay, you know what, the Fed's wrong, this is reality, and growth is going to take it on the chin, then equities are mispriced here. There's an air pocket down for equities if in fact the bond market is right. If the bond market is just panicking over some of these banking issues and not getting growth right, then equities are not so poorly mispriced. So that when the bond market resolves that question, we'll see that reflected in equities, because that goes back to the growth impulse. So, for example, I've got my own fair value model for equities. In a typical recession, earnings get chopped around 15%. That's kind of a run of the mill, not severe, right? So if growth, if we get a soft landing, which I don't think is going to happen, and growth stays kind of, we don't go into recession, earnings don't get cut.
What do you think is going to happen, David? Let's cover what you think is going to happen. Not you said you don't think there's going to be a soft landing. So, okay, that's good to know. You said, I don't think there's going to be a soft landing. What kind of landing? Crash landing? Severe landing?
I think
no landing.
Well, there's two landings we're talking about. One is the real economy, and one is financial asset prices. So
Okay.
the real economy, I think in the real economy, we can probably get by with a mild recession if and when it comes, not if, when, because it's just part of the cycle. They happen. We know that. So why do I think that? I think we'd have the Fed is really concerned with employment. We had over a decade post GFC of just bad employment numbers. It took a long time to reach the 3.5% number that we had before the COVID pandemic. They don't want to repeat that again. So I think that they have the scars that, they're always fighting the last war. So, they don't want that employment situation. So I think they would tolerate modestly higher inflation and make that trade-off consciously for a more shallow recession that doesn't have such a impact on labor markets. So the kind of template for that would be kind of a dot-com type of economic slowdown. So you had a mild recession, not a lot of jobs lost. I think unemployment ticked up by 2%. So that was a mild recession, but asset prices got whacked, and I think that's kind of my baseline, where the recession, when it comes, won't be a hard landing recession, but because valuations are somewhat stretched, I think right. I think the downside for financial assets is considerable.
Okay. All right. Anything
so
else?
Let me throw out some targets. So
all right.
I think if EPS stays flat, fair value is around 34, 36. If EPS pulls back around 15%, which is kind of run-of-the-mill .com type of environment, then we're looking at 3009. If we get a bad recession and earnings get whacked by around 30%, then we're looking at 2750. So that's the way I'm viewing it. Just taking my cues from the bond market and the economic cycle.
Did you say 3009?
3009, correct. For if you have 15%.
How do you get that 9 in there?
We can make it 3,000. That's fine. What's 9 points between friends?
Isn't 3,000 close enough for government
close
work?
Enough.
All right, I just was checking my hearing. David, I'm glad that I invited you. It's great to talk to you, and bond guys. I knew a lot of guys from the Board of Trade that were big thinkers to be in the bond pit. They didn't just trade flow, and you're ready to answer people's questions and looking for followers. Could that be the case? Because I'd recommend that people follow David at Pinebrook Cap on Twitter, and you're open to receiving questions and people talking and watching your stuff, right?
Absolutely, and I've been toying a lot with the idea of doing a lot more long form writing and publishing it, just because Twitter is, it's not the best format or platform for long form, right. Long form writing. Sometimes some of my threads get a little obnoxiously long, so that's something I need to get on and lay out my thoughts out a little more.
And then just put the link in your tweet.
Sure, exactly.
Yeah. All right, so David Cervantes, have a great spring trading season with the money that you're managing, and thanks for edifying our community about potential downside targets in the S&P, depending upon whether the parachute works or not.
All right, have a good weekend. Thanks for having me on.
All right, David Cervantes, everybody, follow him at Pinebrook Cap. Everyone have a great weekend. Remember, do your work over the weekend so you're executing instead of trading on the fly. And above that, don't just count your pips, count your blessings. We'll see everyone Monday. You could join the team in 20 minutes on the Morning Edge. Thank you, everyone. Hope we added value to what you're trying to accomplish, because it ain't easy. Right, David? It's not so easy, is it?
It's a grind. It's a long game. It's a grind.
I'm a grinder. All right, David. You know what you are now after this interview? My trading warrior brother.
All right. Awesome.
You got it, to be
All right,
able
brother.
to, take it easy, David. Have a great weekend. And to the rest of you, adios.
Take care.
Thanks
you.
again, David.
Bye-bye.
You're welcome, Barry, Joe, everyone. People are thanking you. Follow him at Pinebrook Cap.